HDFC and HDFC banks are preferred by everyone in the stock market. From mutual funds to FIIs, everyone invests in them and earns good returns. But the news of their merger was not supported by the market. Maybe that's why their share price is falling after the merger announcement. Shares of HDFC Bank fell by 19% and that of HDFC declined by 20%. Market cap of more than 2.5 lakh crore rupees has been eroded. Amidst all this, the quarterly results of the bank were below expectations. The fall in these shares also drove the benchmark indices downwards. In the FY, starting from 1st April, Sensex and Nifty have fallen more than 3%. Nifty and Nifty Bank both have fallen below their 200 moving average. This indicates that market will remain in the grips of bears for medium to long-term period. However, in this period, the mid-cap index increased by 1.4% and the small-cap index went up by 2.32%. So the fall is limited to prominent shares and large-cap indices. However, experts believe that if the fall in the market continues, then these indices may also follow the trend. Besides HDFC Twins, results of IT companies were also below expectations, which further dented the mood of the market. Due to the rise in cost and higher attrition rate, margin of TCS remained flat at 25%. Similarly, the margin of Infosys declined by 193 basis points and came at 21.6%. Besides poor earnings performance, continuous selling by FIIs, geopolitical tensions due to the Russia-Ukraine war, and an increase in COVID-19 cases are also spoiling the party on Dalal Street. FIIs have continuously remained sellers in April. Foreign investors have till now sold the shares worth 4,255 crore rupees. HDFC and HDFC banks are the biggest contributors to that. Now the market is at a critical juncture. 16,824 is the important support level for Nifty. This is 50% below the high of Nifty retracement and is 200 days exponential moving average. Lead research of 5paisa.com, Rachit Jain says that if the index breaks this level, then selling will intensify. It will breach the retracement level of 61.8%, which is around the level of 16,600. If there is a recovery in the market, then the level of 17,250 to 17,300 will act as resistance. Going above it won't be easy. Due to volatility in the market, a trader needs to refrain from taking an aggressive position. Look for few shares for trade of both sides. Money9 suggests, for investors in this volatile session, it is better to avoid trading. From long-term point of view, good shares can be bought on fall but in a gradual manner.